What you're looking at on your screen right now is a golden egg. A question that I have for you: if you were given a golden egg as a business owner, would you take it? What might be going through your mind is the egg solid gold? Would it be free? What could you do with it? So there's a number of questions that would be going through your mind as to how you could use that golden egg. I'm here to tell you that our legislators have given us business owners a golden egg. In 1986, through the Tax Reform Act, they created a special area of the tax code called 831B. That is a captive insurance company. And I believe it has truly given us the most powerful business tool that we have today, therefore giving us a golden egg. So I want to talk about owning your own captive insurance company and what's involved with that. But let me first give my disclaimer. Owning your own insurance company has implications in a number of areas, including but not limited to estate, gift, and income taxes. You're advised to rely on your own legal and your own tax advisor to help you navigate through the various tax issues. Neither I nor my representatives give tax or legal advice. So please consult with your own attorney, your own accountant, your own tax advisor for any additional tax information about the 831B captive insurance companies. Let me ask you this. Is it for you? At this point, you're not sure. You'd like to know what the advantages are. What are the disadvantages? I'm going to cover those. As you can see, business owners and businesses, we all have risks, such as cyber attacks. And those cyber attacks can be inside our own company from perhaps an employee. They can be outside an attack, as we know, data breaches. And what's associated with those business risks and perhaps a cyber attack, we have perhaps legal issues that may come our way. We have business interruption that may come our way. It may lead to putting us out of the business. So there can be business interruption. That is a risk. For, let's say, a restaurant owner or a restaurant. Foodborne illnesses. Those are big risks for a restaurant. A legal defense. If we do have a lawsuit that comes our way, for any reason, do we have the coverage in a legal defense fund to cover that? How about our deductibles? Sometimes doctors have to have a much higher deductible, or wish they could have a higher deductible, but they've had a claim, so they have to have perhaps a lower deductible. If they had a captive insurance company and had their own insurance, then they could save money by having a higher deductible. Therefore, their commercial insurance, medical malpractice insurance, deductible could be much higher, therefore saving them money. When we look at our business assets, we have tangible and we have intangible assets. So I want to just show you a comparison of the two. A tangible asset, as you can see, such as a named peril insurance policy. A traditional insurance company or a commercial insurance company that you have now, you have named perils. And those are risks to your business that are insured by that current policy. That risk is easily transferred once your premium is paid. So the business has the risk. You transfer the risk from you to the insurance company. That's what insurance is all about. Once you pay that premium, that's the way it works. And this is very similar to homeowners insurance or to our auto insurance that we have. And it's the same for our commercial insurance. There are fixed assets that are also considered tangible assets. Now, in regards to intangible assets, you can see that it's hard to really quantify or assess them. Oftentimes they're inadequately managed because they're hard to assess. They're hard to quantify them, so they're hard to manage. They're usually excluded from our traditional commercial insurance policies that we pay for. And we generally self-insure those types of risks. Not all the time, but generally. So more specifically, a tangible asset is like our buildings, equipment, vehicles that we might own, any business property that the company owns, any inventory that we might have. Intangible assets would be our cash flow that we have. Intellectual properties, any supply chains that we have that supply the goods that we might be selling or the product that we sell. Our brand and our reputation, that's an intangible asset, and it's very important for all of us business owners. Contracts that we might have with other businesses, suppliers, and then any proprietary systems as well. Those are intangible assets. And the last one that I didn't mention is blue sky. That's very difficult to determine and get our hands around. It is an intangible asset. So if you look at the chart, so if you look at the types of risks that are covered, and this iceberg is a perfect example, you can see that the tip of the iceberg is typically covered by our traditional commercial insurance carriers. And those large captive insurance companies will cover anything above the waterline or above or the tip of the iceberg. Now, for an 831B, they specifically cover the hidden risks. And those are usually underneath the water. Those are the intangible assets. So as you can see on here, hidden risks are usually self-insured, but they're increasingly covered by families or family-owned captive risk management programs. And you can see to the right, some of those typically excluded risks are business disruption or interruption, deductibles, employee liability insurance, defect and warranty insurance, reputation damage, credit and bankruptcy, administrative actions, of course D&O and E&O and fiduciary risks, and legal defense. These are all risks that are covered or can be covered when you own your own captive insurance company. Business risk management. We need to manage the risks that we as business owners have. So there's a broad approach to this. We mitigate the risks rather than threaten our intangible assets. We manage those directly and indirectly. We minimize the losses. And one of the ways to do that is using a captive insurance company. So we want to recognize the gaps in our coverage under traditional commercial insurance. And it's those gaps where a captive insurance company can be very powerful and helpful to you and to me as business owners. And you can see the last bullet, self-insuring risks. They're not covered by traditional carriers. In other words, when you self-insure, you don't have any insurance. You just have money that you have set aside in order to pay for those types of risks, but you don't have the benefit of having an actual insurance carrier or company behind you that can pay for a claim if you were to make one. Now, the business risk management and an 831B go hand in hand. To manage those risks, as I mentioned at the start, in 1986, our legislators, through the Tax Reform Act, created this specialized code. Now, captive insurance companies have been around since the 1600s. They've been around a long time. We just haven't heard about them until 1986, when our legislators then created this section of the tax code, which is called the 831B section. And they provided that incentive, or the golden egg, if you will, to own a small property and casualty insurance company to help. It's to help us business owners. It first started out that the first 1.2 million of the premium paid to the insurance company, that wasn't taxable. And that was adjusted to 2.2 million last year. In the beginning of this year, it was adjusted for inflation, and it will be in the coming years as well. It was adjusted to 2.3 million. So beginning in January of 2018, you could pay into your captive insurance company premiums equal to $2.3 million. And with that, there is a line item expense that comes with that to the business company, and then it's payable to the insurance company. And insurance policies are actually provided to protect your business if you had such a claim and you wanted to file that claim with your own insurance company. Now, there's a three-part test that IRS puts the 831B captive insurance companies through. They want to make sure that there's risk shifting, meaning there's a transfer of the risk. You, the business owner, the business, you have business risk. If you transfer that risk to an insurance company, we do the same thing with homeowners insurance. We do the same thing with our car insurance and personal liability insurance. We transfer the risk from us to an insurance company to pay or help pay in the time of a claim. That is one part of the test that IRS is looking for. The second part is risk distribution. And there's a couple revenue rulings that address how to do this, but basically it is unaffiliated risk through a reinsurance company or an 831B captive company. The fortuitous risk, that means that you cannot insure for ordinary business risks. So you might have some form of cyber attack in your commercial insurance policy. However, it probably does not go far enough or further than it really needs to. So you would have your own captive insurance company that has additional coverage for a cyber attack or business interruption. If you could, restaurants can get limited foodborne illness coverage, and through their captive insurance company, they can get much greater coverage. So a captive insurance company fills in those gaps that our commercial insurance company cannot. It does not replace your commercial or current insurance company. It adds to it. It fills in those gaps. The reinsurance company reinsures risks from a frontline insurance company. That's the risk shifting test of that three-part test. There is what's called an allied reinsurance company, and that is simply a group of insurance companies that share in those insurance contracts the risks. It's a pool. So we make a payment to the insurance company. The insurance company, there's several of them, and there's not just one insurance company that wants to insure for the full amount. So we have a group of insurance companies that would bear the cost of a claim if there was such a claim. Now, this 831B is a tool to manage our business risks. It insures risks that may potentially affect your company's intangible assets. That's the fortuitous risk. So we have those three parts that are covered that IRS is looking at. There's an additional profit center that is created through the underwriting. In other words, you get to control the costs of a claim. So you may, as a business owner, submit a claim, or you may not. It is your choice to do that. Now, you can do that with your current commercial insurance carrier as well. And you have the same rights and privileges with a captive insurance company. This is a real insurance company. You own that company. There's also investment income, that when a premium is made to your insurance company, that insurance company then can use those monies to have in an account to create income, investment income. It also can be taken out after they become what is considered profit after 1 year, and be used in any way that you, the business owner, may choose to use them. Some use those funds for R&D, research and development. Some use them for buying other equipment. Some use it to purchase other buildings. There's many different uses that can be made once the money comes out, and there's a process of doing that. The entity that this captive insurance company is a C Corp. And with that C Corporation, the way that we form them that here onshore through a specialized method, and it's a domestic corporation, but it's like having an offshore entity. There's low startup costs and low maintenance costs from year to year. Every corporation has costs from year to year, and so does a captive insurance company. However, it is relatively it's very inexpensive. You also get, as a C corporation, preferential tax rates. And there's, as I mentioned, the distribution options for owners. There's several of them. Now, kind of to diagram how this risk shifts. You, ABC company, you own a captive insurance company, and then from there, the captive insurance company pays and purchases policies. Those policies then, those insurance companies are assuming the risk, and they are issuing the policies back to the captive through the captive insurance companies, which then protects your business, your company. So as you look at the risk distribution, you can kind of see from the pie chart here that an allied reinsurance company, which is what this is, a group of reinsurance companies that share the same risk on a pro rata basis as they are submitted to the pool. So there's not just one insurance company. There would be many insurance companies. There could be 5, 6, 10, 15, 20 insurance companies that are included into this pool. And this just kind of gives you an example of the percentages and kind of the ownership. So if a particular reinsurance company owned 11% and they paid $220,000, then that is just a portion of the pool. So we're not dependent upon one insurance company. There's multiple insurance companies that are involved with reinsurance. Now, this fortuitous risk that I've mentioned, policies are typically issued that cover fortuitous risk. These are outside of the traditional insurance that you currently have. Unauthorized access, supply chain interruption, business interruption, that's different than supply chain interruption. Recall. Any recall notice. Maybe some of you as business owners have had products that you've had to recall. And you weren't able to have any insurance to cover your losses. Brand protection. Foodborne illnesses. Professional liability coverage. And that's over and above. Again, it's filling in the gaps. It's not replacing your current insurance, but it's adding to it. Therefore, your deductibles can go up, which will save your business money. Dispute resolution. If there's any legal issues that come about that your current policy does not cover, then you could look to your insurance company to help supplement or pay the claim. Political risks. If there are any political risks that may affect your business, then you can file a claim with your insurance company and it be covered. Now, the current climate of the 831Bs has had some scrutiny. And if someone did an internet search, you're going to find some good things and you're going to find some bad things. And there are abuses out there, as you can see kind of on the Dirty Dozen list, the last bullet, unscrupulous promoters. Yes, in every industry there are those that take advantage and try to do something outside of what our legislators originally intended and what the guidelines are. If you follow the guidelines, there are no problems. IRS does not have a problem with the 831B captive insurance companies as long as they're done correctly. So IRS has had some concerns, and in fact in 2016 they did issue a notice and they issued transactions of interest. So I want you to be aware of this if you do a search out there, or if someone who is not an expert, who does not specialize in 831B captive insurance companies, they may not understand this. And that can come from CPAs, it can come from other legal professionals, it can come from other advisors, it can come from anywhere. Insurance agents, they're quite, they might not be quite as knowledgeable as an 831B insurance company advisor ought to be. Justifiable premiums. That is one area that IRS is looking for. Are the premiums, which would typically be and can be higher than your current insurance company, and they want to know, is there justification? So there's an actuarial report. There's actually scientific data that goes into determining your premiums and the coverage that and through the insurance policies that are issued. There's poorly written policies. That's a concern of theirs as well. The ownership structure, that's a concern. Offshore companies. So you may know of someone, or you might be considering an offshore company. Let me say that there is another option that is less expensive, that still gives you the privacy and protection, that is looked at as if it is an offshore corporation right here within the 50 United States. So the domicile is here in the States. It makes it easier for banking. The fees are significantly less. It is so much easier to operate a captive insurance company when it's onshore versus offshore. But again, that's on their Dirty Dozen. They're looking for those types of captive insurance companies. This is not a tax avoidance strategy. This is about insuring risks that you normally cannot insure against with your business. Again, it fills in the gaps. However, there are some significant tax advantages of owning your own insurance company. The barriers to entry are certainly lower now than they used to be. There is an increase of states that now allow captive insurance companies to be domiciled in their particular state. I will talk privately with anyone who might be of interest after we do a risk assessment and determine whether a captive insurance company is suitable for your particular business, and we will discuss where to have your corporation domiciled and where the entity would be formed. There are the decreased maintenance and formation fees. And you would be surprised that it is extremely inexpensive to form and maintain this captive insurance company. And as more and more cases have been, lawsuits have been filed against those that have abused this particular statute, we're finding more and more strong case law that defines exactly what to do and how to form and maintain your captive insurance company according to the way our legislators intended it to be. And it is becoming a normal business practice amongst small to middle-sized businesses that has gross revenue of a minimum of $500,000 a year. So you have to be profitable as a business each and every year, and you have to be making about $500,000 gross revenue or more on an annual basis. That is not an IRS requirement. However, just from a practical standpoint, because it does cost money, there are startup costs, and then there are a small annual maintenance fee that will be paid each and every year. So there are some expenses that continue to be paid. So you need to be generating revenue and be profitable. The economic survival is a very important point. Some companies, small businesses, are having to go out of business because of a lawsuit. They didn't have the proper, or they didn't have enough coverage. They didn't have the coverage that filled in gaps where their current coverage left off, and therefore it put them out of business. This 831B captive insurance company will help protect you. The management company. We operate as a management company. We're licensed manager, and we ensure compliance with that three-part test. We work directly with a preferred domicile. And as I mentioned, I can talk more specifically with each and every one of you for those of you that might be interested in pursuing this further. We have a team of tax and law professionals that are extremely proficient in the 831B tax code. And we work closely with the insurance owner's trusted advisors. That means you as a business owner, we're not looking to replace your CPA, your attorney, your insurance agent. We're not looking to replace them. This is filling in those gaps. It's supplemental. It's another tool. It's that golden egg. So we'll work with your team. On the administrative side, what we do is we will assist in the formation process. You have some paperwork that needs to be completed, but we will do that for you. We coordinate all agreements. We'll help you set up the initial bank or investment account, whichever you prefer. You're in control of this. And we also do the annual corporate filings and as well as the tax return. So the corporate tax return will be done. This is like a turnkey operation that you can own and operate and be a part of, but we will manage it for you, and you need us to do that. Any financial statements that are needed, those are provided as well. So if you kind of look at this, some of the benefits that a captive can bring to us as business owners, there's the risk management. It manages business risks that we as business owners have. We are able to control the insurance costs by owning this captive insurance company. And then we also have expanded insurance coverage. Again, it fills in those gaps that I've mentioned. And that all brings us into the center of wealth building. It creates more wealth for us small businesses. Now, if we look at this chart, I have compared commercial insurance with self-insurance because many small to medium-sized businesses are self-insured, or a part of their business risks they are self-insuring. And if we compare that with a captive insurance company, you can see that for risk protection, a commercial insurance provides that coverage for you. So does a captive insurance company, but self-insurance does not. Are the premiums deductible? When you self-insure, well, there are no premiums. So there's no tax advantage that you have being self-insured. But with a captive and commercial, you do. So as you can see, in all of the categories, asset protection can lower insurance costs. A captive will do that. Policy design control. With your commercial insurance company, they tell you exactly what you get. You don't get to negotiate, you don't get to discuss it with them, and then they tell you what the premium is, and you either take it or you leave it. With a captive insurance company, you own it. So you get to help design that. What do you want? What do you not need? How much? You're involved in the design of that. And there is no insurance involved when you're self-insured. Claims control? Absolutely. Now in self-insurance, you are also controlling the claims. You can file claim or not. And there is investment income that comes with captive insurance companies. Yes, there is. And there's other business advantages. Yes, there are, that I can talk with you offline, but for the purposes of this presentation, know that there are other business advantages, significant business advantages. There also can be estate planning benefits with a captive insurance company, and not with self-insurance, and certainly not with commercial insurance. You access reinsurance markets. Yes, we do. The captive insurance market does. It's that group or that pooling of the insurance policy together, so not one insurance company is simply covering any particular claim. And there's new revenue streams that this opens up for you as a business, whereas with a commercial insurance company, you pay your premium at the end of the year. Even if you don't have a claim, you usually don't get any refund back of your premium. And that's true, right, of our homeowners insurance and our car insurance. We don't get a refund. We don't get any type of revenue stream. Well, with a captive insurance company, you can. And another look at this golden egg that a captive insurance company can give you. There's improved risk management that comes with this. It reduces your insurance costs. You have improved cash flow. It will save you in taxes immediately. You have enhanced asset protection. You're going to improve your estate planning strategies. You're going to reduce your income taxes, and you're going to certainly increase your claim control. I do offer a free consultation that to anyone that might want to take advantage of that, and we'll have a discussion about your particular situation and that stage that we go through. We call it phase 1. It's the discovery and education. We're discovering about you. We're going to talk more about the right fit. If this makes sense to you, it might not. Not every business owner is a right fit for a captive insurance company. There's not enough business risks. And then once we determine that, we could move into phase 2, which is determining the risk. And we have an actuarial report that is completed, and it determines our risks and the premiums to be paid. And then if you as a business owner want to continue and we determine that there's enough risks and that a captive insurance company could be beneficial to you, we move into phase 3, or the implementation of your new captive insurance company. And then phase 4 is just the ongoing monitoring and adjustment year after year that we would make in regards to your captive insurance company. So with that, if you would like to have more information, I am certainly willing to hop on the phone and have a phone conversation. If we can't meet in person, we would just meet by phone or Skype or some other method in order to discuss the possibility of you owning a captive insurance company. So I would encourage you to consider the golden egg that our legislators have given us small to medium-sized business owners since 1986 called a captive insurance company and the 831B section of the tax code. Thank you.